Hey everyone, welcome back to the channel. Today, I'm pulling back the curtain and showing you exactly how I invest $1,000 every single month. A lot of you have been asking for this, so I wanted to create a super practical, no fluff guide that you can actually use. This is just my personal strategy that has worked for me, and I'm sharing it for educational and entertainment purposes. You should always do your own research and consider your own financial situation before making any investment decisions. But my goal here is to demystify investing and show you that it doesn't have to be complicated. You don't need to be a Wall Street wizard or spend all day staring at charts to build wealth over time. So, if you're ready to see a simple, straightforward approach to investing, stick around. First, let's talk about the mindset. The most important part of my strategy isn't what I invest in, but how I invest. My philosophy is built on three core principles: consistency, simplicity, and a long-term perspective. Consistency is key. I treat my $1,000 investment like any other bill. It's non-negotiable. I have it automated so that on the first of every month, the money is transferred and invested without me even having to think about it. This technique is called dollar cost averaging. It means I buy a set dollar amount of an investment on a regular schedule, regardless of the share price. Sometimes I'll buy when the price is high, other times when it's low. Over time, this averages out my purchase price and removes the stress of trying to time the market, which is nearly impossible to do successfully. Trying to guess the market as peaks and valleys is a recipe for anxiety and often leads to poor decisions. Like panic selling or buying out of FOMO, automating it takes the emotion out of the equation. When I first started, I was overwhelmed by all the options: individual stocks, bonds, options, crypto, you name it. It felt like I needed a PhD to understand it all, but I quickly realized that complexity is the enemy of the average investor. My goal isn't to beat the market or find the next 10-bagger stock. My goal is to capture the market's overall growth, and for that, a simple approach is best. I don't waste time picking individual stocks because, frankly, I don't have the time or expertise to analyze hundreds of companies' balance sheets. The pros who do this for a living often fail to beat the market average, so what chance do I have? Instead, I focus on broad market index funds and ETFs. This way, I'm not betting on a single company to succeed. I'm betting on the entire economy to grow over the long term, which historically, it has always done. And that brings me to my third principle, a long-term perspective. I'm not investing this money for next year or even the year after. This is money for my future 10, 20, 30 years down the road. This long time horizon is my biggest advantage. It allows me to ride out the inevitable market downturns. The stock market is volatile in the short term. There will be crashes and corrections. It's not a matter of if, but when. A long-term mindset prevents me from panicking when the market drops. Instead of seeing a dip as a crisis, I see it as a sale. My automated $1,000 investment is now buying more shares for the same price. It's like my favorite store having a 20% off sale. Why would I stop shopping? This perspective is crucial for staying the course and not letting short-term noise derail my long-term goals. So, with those principles in mind, consistency, simplicity, and a long-term view, let's get into the nitty-gritty. Where does my $1,000 actually go each month? I use what's often called a three-fund portfolio, but with a little twist. It's simple, diversified, and low-cost. Here's the breakdown of my $1,000. The biggest chunk, $700, which is 70% of my monthly investment, goes into a total stock market index fund. For me, this is something like VTI, the Vanguard Total Stock Market ETF. An ETF, or exchange-traded fund, is like a basket that holds hundreds or even thousands of different stocks. By buying one share of VTI, I'm essentially buying a tiny piece of over 4,000 US companies, from the largest ones like Apple and Microsoft to smaller up-and-coming businesses. This provides incredible diversification. If one company or even one sector performs poorly, it has a very small impact on my overall portfolio because it's balanced out by all the others. This fund is the engine of my portfolio, designed to capture the growth of the entire US economy. It's my core holding, and it forms the foundation of my long-term wealth-building strategy. The next $200, or 20% of my monthly investment, goes into an international stock market index fund. I personally use VXUS, the Vanguard Total International Stock ETF. While the US market is huge, it's not the whole world. Over half of the world's stock market value lies outside the United States. Investing internationally diversifies my portfolio even further. Sometimes, the US market will outperform international markets, and other times, it will be the other way around. By holding both, I smooth out my returns and reduce my dependence on the economy of a single country. This fund gives me exposure to thousands of companies in both developed markets like Japan, Germany, and the UK, and emerging markets like China and Brazil. It's about global diversification and not putting all my eggs in one geographic basket. This is a very aggressive allocation. At 90% stocks, this is because my time horizon is very long, and I'm comfortable with the higher volatility that comes with stocks in exchange for higher potential returns. However, I do allocate a small portion to a different asset class for balance. The final $100, or 10%, goes into a real estate investment trust, or REIT ETF. An example would be VNQ, the Vanguard Real Estate ETF. A REIT is a company that owns and often operates income-producing real estate. Think office buildings, apartment complexes, shopping malls, and hotels. Investing in a REIT ETF allows me to invest in real estate without the hassle of being a landlord. It provides another layer of diversification away from traditional stocks. Real estate can sometimes move differently than the stock market, and it also tends to pay out relatively high dividends, which are then reinvested to buy more shares. This 10% allocation gives my portfolio a little exposure to the real estate market and its unique characteristics. Some people might prefer bonds for this portion to reduce volatility, which is a classic and very valid strategy. However, at my age and with my risk tolerance, I prefer the growth potential and dividend income from REITs. So, to recap the allocation, for every $1,000 I invest, $700 goes to US stocks, $200 goes to international stocks, and $100 goes to real estate through a REIT. That's it. It's incredibly simple. All three of these are low-cost ETFs. It's crucial to pay attention to expense ratios. The funds I use have expense ratios of less than 0.1%, which means my investment costs are extremely low. High fees can eat away at your returns over time, so always opt for low-cost index funds and ETFs whenever possible. Now, let's talk about the where. Where do I actually do this? I use a low-cost brokerage firm. There are many great options out there like Vanguard, Fidelity, or Charles Schwab. I personally use M1 Finance because their platform is built around this pie investing concept, which makes my strategy super easy to automate. I create a portfolio pie with my desired allocations: 70% VTI, 20% VXUS, and 10% VNQ. Then, I set up an automated transfer of $1,000 per month. The platform automatically invests the money into my pie, maintaining my target allocations. If one slice of my pie grows faster than the others, the new money will automatically go towards the smaller slices to rebalance it. It's a completely hands-off system, which is perfect for my set-it-and-forget-it approach. Most major brokerages now offer similar features, like fractional shares and automatic investing, so you can implement this strategy almost anywhere. The most important thing is to choose a reputable low-cost platform that makes it easy for you to stick to your plan. You might be wondering, what about bonds? What about crypto? What about individual stocks like Tesla or Amazon? For me, bonds don't fit into my strategy right now because of my long time horizon. As I get closer to retirement, I will gradually shift some of my portfolio from stocks to bonds to preserve capital and reduce volatility. But for now, I'm focused purely on growth. As for crypto, I view it as speculative. I have a very small, separate amount of play money that I might use for things like that, but it is not part of my core $1,000 per month retirement strategy. And as I mentioned before, I avoid individual stocks because of the risk and the research required. The 3-fund, or in my case, 3TF strategy, captures the upside of thousands of companies, which feels much safer and smarter for my long-term goals. The beauty of this strategy is its elegant simplicity. It frees up my time and mental energy to focus on other things, like my career, my hobbies, and my family, all while knowing my financial future is being built consistently in the background. Investing doesn't have to be a second job. By automating a simple, diversified, low-cost strategy, you can put your wealth building on autopilot and let the power of compound interest do the heavy lifting for you over the decades. It's not a get-rich-quick scheme, it's a get-rich-labutually plan, and that's a plan I can stick with for life. I hope this detailed breakdown was helpful and showed you that a powerful investment strategy can also be a simple one. If you have any questions, please drop them in the comments below. I do my best to read and respond to as many as I can. What does your investment strategy look like? I'd love to hear about it. Thanks so much for watching. If you found this video valuable, please give it a thumbs up and consider subscribing for more content on personal finance and investing. See you in the next one.